Hello, how are you?
Yeah, I'm fine, thank you. How are you?
Yes, I'm fine, thank you. I was just looking at your answer.
Yeah, I didn't get a chance to send it yesterday.
No, it's all right. Yeah, a few comments. Pam Group. It's good to say statement of. Yeah, that's right. Yeah, consolidated statement of financial position. That's correct. Yes. So that's all right.
Okay.
Where did you miss?
Yeah.
Only one point you have missed it because you remember the who our Pam bought an investment from him for 10 million,
Yeah.
right? And there was a intercompany profit of 2 million. Of that, 25% we removed it. So that
Yeah.
investment should appear at 9.5 million in our consolidated statement.
That's what's missing then.
That's missing. So just after investment in associate, you will have
Yeah.
another one called investment, 9.5 million.
Okay, and I'm just checking my workings back for the 9.5 then.
That is in the unrealized in the provision for unrealized profit, we made a 500,000 intercompany.
Oh yes, yeah.
This is number 2. Pam purchased a portfolio of investments from him at a cost of 10 million, on which him made a profit of 2 million. So 25% of 2 million, we have to reduce it because that's intercompany profit. So the 9.5 million should appear in the balance sheet.
Right, yeah. Yeah, I've obviously missed the...
That's all right. That's all right. If you can go up to this level, you are more than a successor, more than a conqueror, I would say.
They seemed quite generous in this question though, didn't they? Because I thought with the revaluation and there would be more complications with it.
Yeah. But they had fair amount of complications in, selling the inventory being sold, being converted into property, plant and equipment. So there were few complications in the whole thing. But I suppose, you had taken the property, plant and equipment at the right value. Goodwill came at the right value. Investment came at the right value. Current assets, you have definitely done well, removing that 6 million, the bad debts. So everything has come up well except the 9.5 million, which is, could be expected in the exam circumstances. So I'm not unhappy at all with the answer.
Okay.
Yeah. So that's great. That's really good work that you have done. So yeah, this is good. Good. So that 500,000 I was talking about, should have removed it. Investment. So that one should have come. In provision for unrealized profit, 5.7 million. Machinery, 6 million. All right, very good. Yes, all that is the workings are.
Yeah, there it is. I've missed it on that bit, haven't I? I've put in sale of investment and didn't put the figure in.
Yeah, that's correct. Yeah. Because, I understand because, we did not have a column for investment. We didn't have a line for investment. So because we didn't know, it was not in the original balance sheet. So because of that, there was no line. So that is why we missed it.
Yeah.
I think the next time when you are doing, what you will do is whenever you see an investment, you will put a line in their pro forma so that you will never miss that one.
Yeah, okay.
So that's good. That's great. I'm happy with that one. Shall we look at the second part of that question?
Yep.
A little bit of things on the second part. Not so difficult again. Yeah. In the 31st May 2006, Pam purchased goods from a foreign supplier for 8 million. And on 28th February, at 31st May, the trade payable was still outstanding and goods were still held by Pam. Similarly, Pam has sold goods to a foreign customer and all that. When Pam purchased an investment property, all that, company uses the fair value accounting for investment properties. Pam would like to advise how to treat this transaction in the financial statement.
Yeah.
So what are the things that we will have to do? This is according to IAS 21.
Yeah, so at year end we have to restate
Yeah,
the
remember,
exchange rate.
always foreign transactions, on the day of the transaction, we take the spot rate, the transaction rate, and we convert it, anything. So for example, on the 31st May 2006, they should have reflected that 8 million euros. 31st May 2006, the rate is 1.3. So we will take the 1.3 rate and convert and debit the purchases and credit the debit the inventory and credit the payables with that amount.
Yeah, yeah.
Always that's the number one entry. So always the 8 million, we will convert it in the end that purchase goods from a foreign supplier 28th February. So that is the rate of the transaction, that is 1.6 rate we will apply and convert the 5 million into the inventory and to payables.
Yeah.
Then we come to the end, 31st May, the as at 31st, the trill was still outstanding. So there we look at what we call monetary assets, monetary liabilities, non-monetary assets. Right? We have to look at the IAS 21, split the things, monetary assets, monetary liabilities, non-monetary assets, non-monetary liabilities. Any monetary assets and liabilities should be converted at the closing rate. So simply the monetary assets are receivables, cash in hand, and the liabilities are payables.
Yeah.
So we have to convert that 8 million which is outstanding, taking the 31st May 2006 rate, taking it 1.3, we will convert. So 8 million divided by 1.3 will give you how much? 8 million divided by 1.3. Earlier we converted 8 million at 1.6, which was 5 million. Now we will convert it 8 million divided by 1.3, which is 6.15.
Yes.
So the liability has
Yeah,
gone
that's
up. Liability has gone up. From
Yeah.
5 million, the liability has gone up to 6.15. What are you going to do with that 1.5 million?
It's it would be posted to profit and loss on exchange.
That's right. That is a loss that should be reflected in the P&L straight away. Right? That will be a loss that will be reflected in the P&L straight away. What about the inventory? Inventory which remains at inventory which was originally converted at 5 million. Now
so that's
it is not yet sold. What are you going to do with the inventory?
So that has to be restated as well.
No, it is not restated. The reason is it is not a monetary asset.
Oh, okay. So it's nothing's changed since.
Yeah,
Okay.
because the monetary assets we don't, non-monetary assets we don't convert it. That's the rule.
Okay.
Right? Money. So remember, monetary assets and liabilities we convert it at the year end. So we will convert the cash, we will convert the receivables, we will convert the payables. But the inventory being a non-monetary asset, we will not convert. So it will remain as it is. It will remain at 5 million. The original converted figure will remain as it is.
Okay.
That is the one. Second one, similarly, Palm has sold goods to a foreign customer for 4 million on 28 February. It received payments on 31st May 2006. So when he sells the goods on the 28th of February, he will convert it 4 million divided by 1.6, credit sales, debit receivables. 4 million divided by 1.6, credit sales, debit receivables. So that is what he will reflect it, and so that is what we did. So the payment is happening exactly on the financial year end, 31st March. So we will get 4 million divided by 1.3. We will get the money.
Yeah.
Originally, it was 2.5 million, 4 million divided by 1.6. Now we will get, it will be a settled transaction at the end of the day. So 4 million divided by 1.3, which is going to be how much? 3.1. 3.1. 4 million divided by 1.3.
3.1.
Yeah, 3.1, 3.07, so 3.1. So 3.1 is the now what we are going to receive, but our books reflect it as 2.5, so there's a gain of 0.6.
Yeah.
That also we will take it to the P&L. That also we will take it because it's a settled transaction and we will take it to the P&L.
Yeah.
Now we come to the investment property. Investment property, when they bought it on 1st June 2005, it will be converted 28 million. Taking the 1st June rate 1.4, they will convert. Right. So 28 million divided by 1.4, that is the rate on the 1st June 2005, it will be converted and that will be converted at $20 million.
Yeah.
Right. So that is what you will reflect that one. Now, being a non-monetary asset, you will not convert it at the exchange rate on the day of the transaction, on the reporting day. It's a investment property is a non-monetary asset, so therefore we will not reflect it on that one. But they say the company uses the fair value model in accounting for investment properties. The fair value model. What do you mean by fair value? Yeah. They will restate it at the fair value on the 31st May. So exchange gain or loss, there won't be any exchange gain or loss arising. But we will restate it at 24 million. Right, 24 million is the figure. Now that 24 million we will convert it at the exchange rate, not because of a conversion for anything, but it is the restatement of the value.
Yeah.
So 24 million divided by 1.3, we will convert it. So 24 divided by 1.3, it is 18.5 million.
Yep, that's what I've got.
18.5 million. 20 million was the original asset. So there's a 1.5 million kind of impairment, which we are added to the P&L.
Yeah.
Remember, we are converting purely for one reason, because this company is using the fair value model. If the examiner has told the company is using the historical cost model, we will never convert the investment property.
Okay.
Investment property is a non-monetary asset and therefore it will never get converted. We are only converting the value of the euro figure has got changed and therefore we have to restate the figure only for that purpose.
Yes, okay.
So those are the few things that you need to know. So few things to note down. Always on the day of the transaction, whatever the asset, whether monetary asset, monetary liability, non-monetary asset, non-monetary liability, convert it at the spot rate. Debit and the credit will be converted at the spot rate. At the end, at the closing, any monetary assets or liabilities, monetary assets and liabilities are essentially cash, receivables, payables. Any of those things, we will convert it again at the closing rate. And any gain or loss, we will show it in the P&L. Non-monetary assets are never converted, except in a situation like this where a non-current asset, we are going to restate it at fair value, or we use the revaluation model. In that case, it will be converted only for the purpose of getting the restated value, not to get the exchange loss or gain. Yeah. So that's all we need to know about that one. Not so difficult to make that one.
So would the examiner expect calculations in that answer? Or is it?
Little calculation, because since he has given the exchange rates, he will expect the calculations and to share the loss of 1.5 million will be reflected in the P&L, 0.6 gain will be reflected in the P&L, he will expect that.
Yeah, okay,
That is why he has
fine.
given the exchange rate.
Yeah.
Right. The next part is all theory. It's all about
Okay.
this company has a good reputation for responsible corporate behavior. Since the workforce as a key factor in the profitable growth of the business, companies also came to provide a detailed disclosure relating to environmental matters and sustainability. Discuss what matters should be discussed in Times annual report in relation to the nature of corporate relationship in order that there might be a better assessment of the performance of the company. So remember, there are some what we call GRI, generally reported initiatives, right? General reported initiatives, because now the modern trend is we go beyond the financial statements to provide more additional information. But sorry, global reporting initiative, the GRI, global reporting initiatives. The idea is to provide more information, particularly about the environmental report. The idea is we, being a company, we are somewhat socially responsible to the environment, to the society, as much as we need to be profitable. So
Yeah.
I remember it was, I think if I remember, it was the Mintzberg who said the company has two outputs. One is the goods and services, and the other one is the kind of the pollution that they give to the environment as a consequence of their activity. So
Yeah.
all the organizations, we provide goods and services, but also as a consequence of providing goods and services and whatever the activities, we create some kind of a pollution in the environment. So ACCA particularly is very, very concerned about the environmental reporting. Remember, environmental reporting is still not mandatory, but most of the big companies, they give environmental reporting as part of their annual report based on what we call GRI, Global Reporting Initiatives. There are mainly 4 areas, if you remember: three areas: economic, environmental, and social.
Yeah.
Economic, environmental, and social. So here we need to give some kind of a report about our economy, the well-being of the society. It's not only the salaries what we pay to our employees, the well-being, whether their living standards have gone up or not or whatever, that kind of a thing. Then also about the environmental indicators. You remember, on the environmental indicators, there are many indicators: the energy savings, the water
Yeah.
conservation, carbon dioxide
Yeah.
emissions, biodiversity, energy and waste. And also on the social, we talk about things like products and services, what we produce, because there's so much of uh, stories about various products that we produce which are harmful to the children, high cholesterol, high fat, all that kind of a thing, high sugar. So that is why people are producing low sugar chocolates. All sorts of things are happening in the market, right? That is
Yeah.
also they are exploiting to their commercial advantage. Not that we get anything out of it, but uh, uh, that kind of reporting is very important. So your products and services, how much you comply with the environment, transport, carbon dioxide emissions. So these are some of the things that we want to report. And what about the
Yeah.
employees part of it? Because we say we are basically, we say companies keen to provide and discuss company see workforce as a key factor in the profitable growth. So here we must say in our annual report the way that we treat our workforce, right? The way we treat our workforce, whether we are educating their children and what kind of facilities we give to the families, all that kind of a thing, the employee welfare can come up very well. The detailed working hours, things like the holidays that you provide for the staff or the annual trips or whatever it may be, all that kind of a thing, and health and safety, accidents, those are the things that should be included in the financial statements. So that is what we basically believe through the GRI, to go beyond the financial statements. Beyond the financial statements. What is the purpose? Why do we provide financial statement? The objective of the financial statement is to provide information for the wide variety of users of financial statements to make good, sound economic decisions. That's the purpose of the financial statement. But we go beyond that one and provide some more information to the people, so that the people will know how much we are responsible as good corporate citizens. The idea is no business will survive in the world without being a good corporate citizen. If you are not acceptable to the society of what you are doing, society will not patronize you and you will not survive. On the other hand, if you are surviving, you must be thankful to the society, because you survive because of the society. That's the idea. Okay?
Yeah.
So that kind of answer should have been good, about 7 marks, probably about 3 to 4 points, 5 points, you should have collected the marks.
Okay.
So that's the whole 50 marks for you.
Yeah.
Okay. But I will move into cash flow today, just to see how what we do on cash flow. I sent you a question. Shall we look at that one?
Yeah. Yeah.
Shall we look at that one?
Okay, yeah, I've got that question.
Pardon? Yeah. You remember whether it's a normal cash flow or the consolidated cash flow, there are 3 compartments. What is the cash flow trying to explain? Cash flow is trying to explain from your opening cash and cash equivalents to the closing cash and cash equivalents, how it has got changed. That's the idea of the cash flow. The relevant accounting standard is IAS 7. It's always good to, if you know the name, just say the name of the relevant standard. The IFRS 3 revised business combinations. If you know, if you can remember, just always mention IAS 7. It's the cash flows, the statement of cash flow. It's good to name.
Yeah, because I tend to find that they quite often state them in the exam, because I'm trying to remember all the numbers, and then they tell me in the question.
Yeah. Not easy to remember all, but at least some, as much as possible. Try to memorize few. The IAS 37, it's all about contingent liabilities, provisions, and contingent assets. Right?
Yeah.
IFRS 8 is about operating segments. So like that, certain things, IFRS 10 is all about the consolidated financial statement. IAS 28 is all about the associate company. So like that, you can go on, trying to work out as much as possible as we go along. IAS 19 is all about the employee benefit. So now we have IFRS 9 on the revenue. So like that, we will also come across some of these things when we do. IAS 16 is all about the non-current assets, right? IAS 36 is all about the impairments. 38 is all about intangible assets. So like that, you just have to keep up something so that we can, answer, because those things are going to carry little extra marks for you. Okay, here we have a company, 40-year-old company producing garden statues and carved from marble. 22 years ago, it acquired 100% interest in a marble importing company, hard stuff. In 20W9, it acquired a 40% interest in a competitor, landscapes company. And on 1st January 2007, it acquired a 75 interest in garden furniture design. So what matters for us is not what we have purchased 22 years back, or not even what we have purchased in 20W9. Our financial year is 20 to 20X7. What we need to worry when you are preparing a cash flow statement, anything that happened during this financial.
Yeah.
So all the other information that is given is not really relevant for us to prepare the cash flow statement. What is really needed is the on 1st January it required a 75% interest in garden furniture design. That is what matters for us because our statements are on 31st December 2007. So that happened on 1st January. That is what is happening during the year.
Okay.
So again, I think the best thing what we can do is, if you remember this cash flow has three compartments. The number one, what we call net cash from operating activities, then net cash from investing activities, net cash from financing activities. Right? So the total of all those three plus the opening cash and cash equivalent should be equivalent to the closing cash and cash equivalent. That is what
the last time I didn't pass this exam, it was a cash flow, and I thought I was really pleased with myself that I'd remembered all the layout, but I did appallingly on the other questions.
Yeah, so it's good to remember the format and put. Where do we start? We start with the cash flows from operating activities. So it's good if you can put the heading also. The heading should be a SoftLogic company consolidated statement of cash flow for the year ended 31st December 2007. Remember, only one statement we prepare as at 31st December. What is that statement? Statement of financial position. All the other statements, statement of profit or loss, statement of cash flow, statement of changes in equity, everything is for the year end.
Yeah.
So we will put up that heading always, SoftLogic company, consolidated statement of cash flows for the year ended 31st December 2007. So the first one is cash flows from operating activities, and good if you can put the format. What is your first item always? Where do you start? The cash flows from operating activities on the indirect method?
Operating profit.
Operating profit. Profit before taxation. Yes, that's correct. Right? Actually, it's not the operating profit. It is profit before taxation. If it is operating profit, it is profit before interest and tax.
That's what I would use. That is what I would use, profit before interest and tax.
Yeah, that is not the right one. We must use the profit before taxation. The 5520 is the starting point. Okay.
Right, okay. That's where I'm going wrong then.
All right. Yeah, because after that we will adjust for the interest. We will add the interest and take the actual interest. We always you must start with profit before taxation. 5520 should be your starting figure. Then we have to do certain adjustments. The adjustments, number one adjustment we have to do is you have to add all your depreciation. Right? You have to add all your depreciation. Then look at the question. Shall we read the question and see what the other items there? We have been given the operating profit, but we don't start with the operating profit. We start with the profit before taxation. Then we have been given tax, income tax, all that kind of thing. We have given the two balance sheets of the last year and this year.
Sorry, the sound was going a bit then. So the starting point is 5520.
Always 5520.
Yeah.
Profit before taxation. Remember, that's your starting point. You just put that figure, you are going to get 1 mark. Start with that one. 5520, profit before taxation. Then you have to make adjustments for items not involved in cash, depreciation.
Yeah.
Then profit on sale of any plant. You must deduct it. share of associate profit, investment income, interest payable. When we do all that, we arrive at what we call operating profit before working capital changes. Operating profit before working capital changes. Then changes in working capital. Trade and other receivables. Next line, inventories. Next line, trade payables.
Okay, are they, because they,
Yeah.
I would have put them in that first section, operating activities.
Yeah, it's still under operating activities. Operating activities comes up in three compartments. One is the operating profit before working capital changes. Then we have the working capital changes. Then we call it cash generated from operations. With those three items,
Okay.
it is called cash generated from operations. Then we remove the interest paid and income taxes paid. Then we arrive at the first compartment, which we call net cash flow from operating activities.
Okay.
So first we will do that part of it. Forget about all the other part. We will start work out on the net cash from operating, because that's the most difficult one. We will work on the net cash from operating activities.
Yeah, okay.
So we start with the profit before, net profit before tax, 5520. Depreciation, we need to work it out. Profit on sale of plant, we need to work it out. Share of associate profit, I can straight away take that one. There is a 105 because that they have gone on accrual basis, but we are going on cash basis. So we remove that 105 or we deduct 105 from that figure. So you start with 5520.
Yeah.
So just give me a minute. Five at 520 is your starting point. So we have to make certain adjustments for depreciation, profit on sale, but I will remove the first one, what I can easily remove, 105. That is what share of profit of associate company. That I can straight away remove it. Investment income, I can straight away remove it. They have taken credit for that one, but it's not a cash item, because it goes, it's not that it is not a cash item, it's not an operating item. It will be under investment activity. So remove that one. Remove that one. Then interest payable. We don't take the interest payable based on accruals. We take the interest payable based on actual payment. So add that one. Add that one. So now there are two more lines which we have to fill it up: depreciation and profit on sale of plant. So now my first thing is to work out the depreciation. Now to work out depreciation, what I need to do is I need to open up a working sheet, look at my non-current assets. Look at my non-current assets, because we provide depreciation only on non-current assets. So we have a building. This year, last year it was 6,225,000. This year it is, sorry, last year it was 6,600,000. This year it is 6,225,000. Machinery, cost is 4,200,000, 9 million. Depreciation 3,300,000 to 3,600,000. So the figures is there. There had been no acquisition or disposal of buildings during the year. So immediately I know no acquisitions, no disposal of buildings have happened. So what is the reason for the change of the figure, Fiona?
Because depreciation, not cash.
The buildings at net book value from 6,600,000 to 6 million, from 6,600,000 to 6,225,000. There is a depreciation figure of 375. Correct?
Yeah.
So I can add that one. I can keep it separately. Buildings depreciation 375. Now I come to the difficult part to work out the depreciation on plant and machinery. Plant and machinery. So that to work it out, I have to go by the accumulated depreciation. I start off with 3,300,000.
Yep.
And I close off with 3,600,000. I must see what are the other adjustments before I arrive at my balancing figure. 3,300,000, 3,600,000. So let's go down and see anything else we can pick it up.
So there was some machinery that was sold during the year.
Yeah, there had been acquisition, no acquisition. Machinery cost in 1.5 million was sold for 1.5 million, resulting in a profit of 300,000. 1.5 million machinery costing 1.5 million was sold for 1.5 million. So the machinery, there is a kind of a the 1.5 is the selling price, 1.5 is the cost, but they have made a profit of 300,000. So that means what would have been the written down value of that asset? For them to make a profit of 300,000 after selling for 1,500,000, what is the written down value?
1.2.
1.2 is the written down value, correct? Right, 1.2 would have been the written down value. That is why they sold it for 1.5 million and they make a profit of 300,000. What is the original cost? 1.5.
1.5, yeah.
So 1.5 to 1.2. The written down value has come down from the original 1.5 to 1.2. That means the accumulated depreciation on the asset sold is the original cost was 1.5. Now the written down value is 1.2. That means the accumulated depreciation on the asset sold is 300,000. Agree?
Yeah, 300,000.
300,000. So we have to remove that one, isn't it?
Yeah.
To remove that 300,000 from our opening depreciation, we must remove that 300,000. When you remove that 300,000, when you remove that 300,000, what happens? 3,300,000 minus 300,000. It is going to be 3 million. But the closing figure is 3,600,000. How is that change? What is the reason for the change? Why is the accumulated depreciation gone up?
It hasn't. There's a profit of 300,000.
Depreciation, no profit, nothing. Depreciation is all what we provide. Opening provision was 3,300,000. We sold the asset which carried 300,000 depreciation. So now it came to 3 million down, but the closing figure is 3,600,000.
Oh, I see what you mean. Yeah.
Just think like that. You know, without trying to put into memory and without trying to put the formula. Just think like that. We started with 3,300,000 depreciation accumulated. We had to remove 300,000 because we sold something. Now it should be 3 million, but it is 3,600,000. But it is 3,600,000.
There's an acquisition. There was an acquisition during the year.
If there was acquisition, it will go to the cost, Fiona. If there was acquisition, it will go to the cost. Depreciation provision, how does it increase? Forget anything. Depreciation provision, how does it increase? Last year to this year, why is the increase?
For the current year.
Current year depreciation, isn't it?
Yeah.
Current year depreciation. So the current year depreciation is the balancing figure which is 600,000.
Yeah.
So on the machinery depreciation is 600. On the building the depreciation is 375. So now we have got a big figure out, that is the 975 is the depreciation figure. Are you okay with that one? So we have to add that one, 975. And straight away from that one we know profit on sale of the plant, they said it is 300,000, remove that one. And now you will arrive the first figure, that what I said, that is what we call operating profit before working capital changes. 5520 plus 975 minus 300 minus 1050 minus 465 plus 450 will give us what we call operating profit before working capital changes.
And that's 5130.
Working capital changes 5130 exactly. Now the next thing is to make all the working capital changes. Now normally what we look at is we look at the opening balance sheet, we look at the closing balance sheet, and we take the working capital changes. But here we can't do that one. Whenever we acquire a subsidiary, we have to look at that subsidiary, how much it has improved or increased our working capital. To remove that one. If you have to do a working, we start with inventory. In inventory is 3 million. Closing is 5925. So here the working capital changes. It's easy to do like this, Fiona. But just put 3 columns. Inventory, receivables, payables. Just put the 3 columns and start with the opening. 3 million. First let's look at the inventory part of it. We know the opening is 3 million, closing is 5925. But what we know during, in between, a new company. And that company's inventory was how much? 96.
Yeah.
96. But 3 million figure will go up by 96 purely because of our acquisition.
Yeah.
Now it is 5925, so we can find out the balance. So 5925 minus 3,096,000 will tell us the balance what we have increased. 3 million was our original figure and it went up by 96. So 3,096,000 minus 5925 should give us the figure. Right? How much is that?
2829.
2829. Well, it is an increase, isn't it? It's an increase.
Yes.
So when it's an increase, that means it's an outflow.
Yeah.
So inventory increase, 2829, we will remove it. Can you do the same thing for receivables?
Yeah.
Can you do the same thing with the receivables? Start with the opening balance of 3825. Close it with 5550. And look at how much they have got through the new acquisition.
84.
Yeah. So what is the net increase or decrease? It's increased surely.
1641.
1641, and it's outflow, isn't it?
Yes.
It's increase, it's outflow. Now can you do the same thing with the payables?
Yeah.
Payables, we start on the other side. Start with 840, end up with 15.
Yeah. And payables 204. So 456.
456, what is it? It's an inflow or outflow?
It's an increase.
It's an increase of payables. Yes, when the payables increase, what happens? Is it inflow or outflow?
So it's the opposite way around to the other two. So
Yeah.
they're going to be deducted and this is going to be added on.
Yeah, that's correct. Because always remember, it's better to remember like this. You know, if you increase your receivables, that means your money is dumped in the receivable. If you increase your inventory, your money is dumped in the inventory. But if you are getting more credit or more from payables, that means there's more money inside you. So that means it's a plus figure 456.
Yeah.
So now 5130 what you got plus all these figures will give us what we call from cash generated from operations. 5130 minus 2829 minus 1641 plus 456 will give us the cash generated from operations.
1116.
1116. And now two more adjustments before we arrive at the total cash from operating activities. We have to look at the interest payable and the tax payable. So first look at the interest pay, or rather we have to get the interest paid. So how do we do that one? We look at the opening interest payable.
Where is that?
Interest obligations under accrued interest and finance charges. We have 90 to begin with. And we have a closing figure of 120. Right, so start with the opening figure of 90 and end up with a closing figure of 120. Right, so 90 is the starting point.
Yeah, I was just checking whether there was any adjustments to interest.
There are a couple of adjustments.
Yeah.
In the P&L, we have a 450 figure. So normally what we do is we add the 450 figure. But there's little bit, so normally what we have to do is we must add the 450 figure.
Yeah.
And because the opening liability will go up by the P&L interest payable figure, which is 450, which is true. But here there is some more little adjustment. A little bit what they say about loans were issued at a discount rate and the carrying amount of the loans had included 120 representing the finance cost attributable to the discount and allocated in respect of the current period. That 450 that 120 is not something what we have paid. Right?
No.
It's an allocation. So although we have put 450, that 450 the 450 includes 120. So you have to remove the 120. The 450 includes that 120 also because that has nothing to do with your interest payments. It's only accounting allocation. So now you can see 90 plus 450 minus 120. The figure what you are getting is 540 minus 120 is 90, 450, 540 minus 120 is 420. But your closing figure is 120.
Yeah.
So what has happened to the difference? 420 should be the figure, but the closing figure is 120. Liability account
300.
300, yes. What is that?
So that is
300 is what is that? We started with the opening liability of 90. There was another 450 coming up, but we had to adjust for 120. But we are ending up with a closing liability of only 120. Liability got reduced.
Yeah.
How does the liability get reduced? Liability get reduced because we pay money, isn't it?
Yeah, it's been paid.
Yeah. So the interest paid amount will be 300.
Yeah.
Interest paid amount will be 300. Now one more item. That is only the taxes. Now, whenever we are doing taxes, I'm sure you must be knowing, taxes, we take the opening figure, taxes, both the deferred tax element and the current
Yeah.
tax element together. So opening both the deferred tax and the current tax element together, opening deferred tax is 39, current tax is 651. So we will have a 651 plus 39 coming as the opening balance. Right?
Yeah.
So whenever we are looking at the taxes in the cash flow, we look at both the figures together. So we look at the 651 plus 39, 690.
Yeah.
So that is my starting point. And my closing figure is 90 is the deferred tax element, 1386 is the other element. So my closing tax element is 1476.
So paid was 786.
Now, before that, we have to look at a little bit more. When, right? So whenever, yeah, we have to look at something more because there is, you remember, there was with the acquisition of the subsidiary, we have some taxes liability coming up.
Yeah.
That also must get included. What was the amount that we had to get it from the subsidiary?
51.
51. So that must get added up, isn't it?
Yeah.
Because our opening liability will go up because of our new subsidiary what we took over. There's another 51 coming up. But that's not all. What about our current taxes, the P&L charge? Our opening tax liability will go up because of our current P&L charge, isn't it?
Yeah.
What is our P&L charge?
1485.
1485. That's correct. That also must be added up, isn't it? 690 plus 51 plus 1485 should give me my figure 690 plus 51 plus 1485
2226.
2 51 plus 1485 32 how much?
2226.
3226. What is our closing figure? 690 plus 1485 plus 51 should give me my figure, which is 2226, is it?
Yeah.
2226. What is my closing liability? Again, both together, deferred and the other one together, 1476.
Yes, 1476.
So my liability has got reduced from 2226 to 1476. What's the reason for the reduction?
A payment.
Payment. Tax paid during the year. 750.
Yeah.
So now you will get, when you remove from that what we got earlier, the cash flow from after the working capital changes, we got some figure, and from there 1116, remove the 300 and 750. That will give you the first part of the compartment, which we call net cash from operating activity.
Yeah.
How much that one? Net cash from operating activities, 1116 minus 300 minus 750.
66.
66. So that is my first part I have collected now. It's all right. 66 is all right. Now I go to the next compartment. Net cash flows from investing activities. Cash flows from investing activities. Now invariably in your sums you will have either a purchase of a subsidiary or a disposal of a subsidiary. So whenever we have a purchase of a subsidiary, what we look at is the consideration what we paid in cash, remember only the consideration what we paid in cash minus whatever the cash that we acquired from the subsidiary.
Yeah.
Now, can you look at that one and tell me, look at the figures and tell me what is the ultimate net cash outflow to purchase the subsidiary? Figures. Balance consideration paid in cash, they say 42 million. 42 million, they paid it in cash.
Where does it say that? I'm just trying to find it on the question.
Pardon?
I'm just trying to find it on the question.
Yeah, that is in just under note number 2. Information relating to the acquisition of garden furniture designs.
Oh yes, yeah, okay, yeah. So
Because
cash.
the total consideration was 867, but we don't need to worry about the total consideration. Look at only the cash paid. So there's a cash outflow of 42 million.
Yeah.
But what is the cash inflow?
There's a cash inflow of 336.
It's 336. So 336 minus 42, 294 million is a net inflow. It's a net inflow.
Yeah.
Right. So it's a +1 purchase of subsidiary, the thing, there's a net inflow of 294.
294.
294. Now we come to the next one, which is a kind of another difficult one to do, but we are going to do that one, the movement in the property, plant and equipment. So we have only buildings. So buildings, we saw there was absolutely no movement, 6,600,000 to 6,285,000, no acquisition. So no need to worry. It is only the depreciation. No need to worry about it. Right? But look at the plant.
Yeah. So it's the purchase of the plant.
At the purchase of the plant, we start off the plant with a book value of 900. And we close the plant with a book value of 5,400,000. So it's a question of balance in between these two figures, 900 to 5,400,000. We saw earlier, depreciation was 600. That we had to remove it. During the year, we provided depreciation of 300. Right? Then there was another one. Through the acquisition of the subsidiary, how much did we get as non-current assets? To the acquisition of the subsidiary. The acquisition of the subsidiary, we got how much?
In cash?
Not in cash, I mean in form of assets, how much did it come? Machinery, 495.
495, yes, sorry, 495.
So we have to add 495. The opening balance of 900 will get reduced because of the depreciation by 600, but we have to add another 495. Right? Then we see they took some leased assets. Leased assets. They say 2.55 million new leased assets. So we remember leased assets also come under our normal current assets, non-current assets. 2,550,000 need to be added up. What else do we need to do before we arrive at the balancing figure? Opening was 900, depreciation was 600, 495 is the subsidiary assets, 2,550,000 is the leased assets. What else we need to do? You remember we sold asset. Carrying down value of that asset what we sold was 1,200,000. Right? So we have to remove that one. So can you now work out the 900 minus 600 plus 495? plus 2550 plus 1,200,000 figure.
4545.
How much?
4545.
4545. Right?
Yeah.
900 minus 600, 300. Sorry, this is also minus, huh? 1,200,000 should be minus, no?
No, sorry.
Yeah.
Yeah. Two one four five.
2145. But what is our closing figure? 5400.
Yeah.
What is the reason for increase? Non-current assets figure to increase. After taking into account the acquisition of the subsidiary, disposal, depreciation, if the non-current assets have increased, what is the reason?
There was a new piece of machinery acquired.
New acquisitions. There are two possible reasons why it can get increased. One is a revaluation, but we don't see any revaluation reserves. If there was a revaluation reserve, that also must be considered, but we don't have any revaluation. So 2145 to 5,400,000 difference, 3255 is all the acquisitions. So that is a cash outflow of 3255. That's a cash outflow of 3255.
Yeah.
Right. Then we sold the asset for 1.5 million. So that's a cash inflow of 1.5 million. That's a cash inflow of 1.5 million. That you remember there was 465, they got an investment income. That also should be treated under investing activity. So 465, you can bring it here now. Then the other thing is we have to look at whether we have paid, whether our associate company, whether they have paid any dividends. Now that's the next thing we are going to work it out. So this is a step-by-step process for associate company. Original investment was 3 million. Close it is 3,300,000. During the year, our share of the profit from the associate company was 1,050. So 3 million plus 1,050 is 4,050. But now the figure is appearing as 3,300,000. How come the investment in associate company get reduced? How come the investment in associate company get reduced? It should have appeared with the original 3 million plus the 1,050, 4,050. But it is appearing at 3,300 or 3,300,000. What is the reason?
Impairment.
It could be an impairment, but they don't talk about impairment, isn't it? You're right. It could be an impairment, but they don't talk about an impairment. What's the next reason?
No.
What's the next reason? The next reason is when the associate company pays a dividend.
Yeah.
So from 4,050 to 3,300,000, that means we have got a dividend of 750. Right?
Yeah.
So that also should be an inflow for us because it's a from investment activity we have got another inflow of 750. So we have another one little thing that either we can do it in here or we can do it under financing activities. We can do it either here or there, but I think let's keep it here with these things because what we pay to the non-controlling interest dividend could be treated as a financing activity or could be treated as an investment activity. But I think it's good to treat it as a financing activity. So let's look at the investment activity at this point. 2145 minus 3255. 2145 minus, and then there was a Here. 294 minus 3255 plus 155 plus 465 plus 750. Look at that figure. That's the investment activity figure. 294 minus 3255 plus 155 plus 465 plus 750.
I'm not following now. I've lost this bit.
Okay. Yeah, we had because we bought the subsidiary, there was a net in cash flow of 294. Okay.
Yeah.
Then the acquisition of property, plant and equipment during the year was 3255.
Oh, right. Yes. Yeah.
Right. Then we had the 1500. The 1500 was the sale of the plant inflow.
Yeah, got that. Yeah.
Then we had the dividend from investment 465, and also we had the associate company dividend 750 plus.
Yeah.
So all that is all what is getting from the investment activity.
Okay. So that's 246.
How much is that?
246.
Yeah, 246.
Yeah.
Yeah, that's correct. 246 minus, isn't it?
Yes, it's a minus.
Minus 246. So we have got two compartments. First one was a plus 66. Second one minus 246. We need to work out the third part. I'm sure you will try the third part, the financing activity.
Yeah.
Try to work through the financing activity. We will look at when we made, and we will see how we can proceed with it. Right. So we have done the difficult part, but you can do the financing activity. Look at the share capital increase. Look at the loans increases. Look at whatever the new things that has come up from the subsidiary, and also try to work out the non-controlling interest, and also try to work out the dividend paid by the parent company.
Yeah.
Right. Only thing, Sunday we fixed up a class, no? Sunday.
Yes, we did. 4 o'clock.
Yeah. Can we? How is your program Sunday? The rest of the hours?
It's flexible. So, what is the best time for you?
Yeah. Can we make it around about 6 o'clock in the evening? Is it too late?
So is that 6 o'clock my time or your time?
6 o'clock your time.
Yeah, that's fine. So put it back for 2 hours. Yeah, so 6 o'clock.
6 o'clock your time. Yeah. I have a church meeting. By the time I come, I'm a little late. But surely by 6 o'clock your time, I will be here.
Okay, that's fine. Yes.
So we will make it on 6 o'clock on Sunday. And we will go to this one, and then I will send you some more questions, and we will continue like this.
Yes. Yeah. Okay then. All right. I'll finish this one off.
Okay. And send it to me. Sure. Right here. Okay. Right then. I'll see you on Sunday at 6 o'clock your time.
Thank you. Have a good weekend.
Bye.
Bye.
Same to you.